All right, good morning. We've got a classic conflict brewing for the open. You have bullish short-term catalysts running headfirst into some pretty bearish long-term fundamentals. Here is the game plan for November 12th, 2025. So today's session is shaping up to be a real tug of war. In one corner, you have the bulls, and they're betting big on a shutdown deal getting done and riding those strong seasonal tailwinds. In the other corner, you have the bears, and they are pointing to some really weak consumer data and obvious stress signals coming from the credit markets. Let's dig into the overnight drivers that are setting this stage. Okay, here are the key items you need to have on your radar before that opening bell. First thing, this is a big one. There's a major headwind for the semiconductor space. SoftBank just confirmed they've liquidated their entire, get this, $6 billion stake in NVDA. That is a massive supply overhang for the stock to absorb, and you better believe that's a sentiment risk for the entire AI sector. Now, on the bull side of the ledger, the market is aggressively, and I mean aggressively, pricing in a resolution to the government shutdown. The Senate bill is through, and if you look at the historical data, equities tend to rally pretty hard once these things get resolved. So this is a powerful seasonal tailwind you just can't ignore. But here's where we see the disconnect with the real economy. Google searches for the term second job, they're at all-time highs. And delinquencies, we're talking auto loans, credit cards, mortgages, they're all surging to multi-year highs. For now, it seems the equity market is just choosing to look the other way on these very direct signs of some severe consumer stress. And the credit market, it's flashing a crystal clear warning. Bank of America notes that hyperscaler bond spreads have widened 60%. Why? Because they've issued over $100 billion in debt in just 2 months to fund all this AI capex. The bond market is signaling real caution on the AI trade, and historically, that's a classic pre-correction signal. Okay, let's pivot to the macro risks and the volatility drivers that are on our radar for today. So you look at the VIX, and it's just sitting there, right, between 17 and 19. On the surface, that looks like complacency, right? But believe me, the spot price here does not tell the whole story. The real story, as usual, is in the options market. We're seeing some heavy and frankly unusual call buying in the VIX. It looks like smart money is positioning for a volatility spike to pop above 20, even while the spot VIX is just sitting here asleep. That is a divergence that is absolutely worth paying attention to. And of course, there's the Fed. The market has fully priced in Fed easing. The CME FedWatch tool is showing a 63% chance of a cut in December, and it's basically a lock for January at 99%. Now, this is what's propping up the market, but it's a double-edged sword. It makes the tape extremely vulnerable to any kind of hawkish headline. The real wild card for today is that delayed economic data from the shutdown. We still don't have a confirmed time for its release. Now, looking at the pre-market action, we're already seeing some wild moves. On the upside, you got BigBear.ai ripping up 17%, Rocket Lab up 8%. And on the downside, CoreWeave is getting hit, down 10%, and CleanSpark is off about 5%. All right, let's talk levels. These are the numbers that are going to define today's session. For the SPY, the key upside resistance level is 685. Simple as that. The bulls have to decisively break and, more importantly, hold this level to keep any positive momentum going. It's the line in the sand for the upside. Now, to the downside, our critical support is 680. This is the floor. A break and close below this level pretty much invalidates the immediate bullish structure, and it opens the door for sellers to really take control. And if that 680 support fails, where are we heading? Well, the primary downside target becomes that unfilled gap down at 672.50. That's the next major support zone where you might expect to see some buyers finally step in. For individual names, you've got to keep an eye on NVDA. It's going to be under pressure from that SoftBank supply. Watch the 190 level for support there. Meanwhile, Apple is showing some pretty clear relative strength. Honestly, a breakout to new all-time highs in Apple would be a massive bullish signal for the entire market. Two other themes to keep on the radar. First, the AI picks and shovels plays. Think names like Celestica and SoFi. And second, keep a close watch on these high short interest names. You've got BigBear.ai with a 17% short interest, Rocket Lab with 12%. They're squeezing higher right now, and that momentum could easily continue. Okay, before we get to the actual game plan, here's the mandatory disclaimer. This content is for educational purposes only. It's here to help you stay informed. You must do your own research. This is not financial advice. All right, let's put it all together and build our game plan based on those levels. So here's the if-then logic for today.
Our base case is for choppy, range-bound action between that 680 support and 685 resistance on the SPY. The bull case triggers on a sustained break above 685. The bear case, well, that triggers on a failure to hold 680, which would then target that 672.50 gap fill.
So just to summarize the strategic thinking here, the bull thesis really rests on the shutdown deal getting done, seasonality kicking in, and a potential year-end performance chase from fund managers. The bear thesis is based on an overextended rally, that clear consumer stress we're seeing, and those warning signals from the credit market. Okay, two potential strategies to consider here. First, a volatility hedge. You could look at a VIX call spread for 1 to 2 weeks out, maybe a December 20 by 25, to play for that potential vol spike. Second, an intraday bearish idea for SPY, selling a 686/688 credit call spread against that resistance. Now please listen, options carry substantial risk. Your capital is at risk and losses can exceed the premium you paid. You have to size your positions carefully. Hey, if you find this useful, do me a favor. Like, subscribe, and make sure you turn on those alerts. So the final question I'll leave you with for today is this. Will that institutional chase for year-end bonuses be powerful enough to make the market completely ignore the clear warning signs that are coming from the bond market? And remember, one last time, this is not trading advice. It's a market update to keep you informed. All markets carry risk, so trade your plan, manage your downside, and always verify all your data. Stay sharp out there.